So in part 2, we found something very interesting. We noticed earlier that the numbers aren't bad, but they are not what they used to be. NIM is down, CASA ratio is stuck, ROE has fallen, NII growth has slowed from 20% to 6%, and the management itself is saying it will take 2 to 3 years. So the question is why? Because the numbers tell you what happened, they don't tell you why. And more importantly, they don't tell you whether the people running this bank can actually fix it. So the part 3 is about these three things: management, competition, and the future prospects. So let's get into it. Every banking story eventually becomes a management story. Let me start with the person who runs this bank, Shashidhar Jagdishan. He's been CEO since October 2020. Before that, he spent over 2 decades inside HDFC Bank in finance, operations, technology, and HR. He essentially grew up inside this institution. He's not an outsider brought in to turn things around. He's a product of the system. That's both his biggest strength and a question mark. His strength is that he understands this bank at a molecular level. When he talks about deposit mobilization strategy, branch productivity, cost of funds, he is not reading from the briefing, he has built those systems. And if you listen to him carefully in the quarter 3 earnings call, there's a quality to the communication that the most bank CEO don't have. He's honest about where they fell short. On quarter 3 call, he said directly, "We did fall short of our strong ambitions on deposits." That's a rare thing for a CEO to say publicly. But the question marks this: Jagdishan has been running this bank through what is arguably its most difficult period since inception. The merger integration, the NIM compression, the CD problem, the governance crisis. And the results, while not disastrous, but have clearly disappointed the market. ICICI Bank under Sandeep Bakshi has pulled ahead significantly in both stock performance and operational metrics during the same period. Now, here's where it gets complicated. The chairman who just resigned, Atanu Chakraborty, reportedly opposed Jagdishan's contract renewal. The Financial Times reported a power struggle between the two. The board majority sided with Jagdishan. Chakraborty resigned. And now, Jagdishan's reappointment is pending for RBI's approval. So right now, the person running the India's largest private bank and his future at the institution is literally an open question. The RBI has to sign off. And given everything that just publicly happened, that process is going to be very carefully watched by everyone. This is not a small thing. Leadership continuity at a bank of this size and complexity matters enormously. Integration strategies, deposit mobilization plans, the entire HDFC 2.0 roadmap, all of it sits on the assumption that the same management sees it through. The AT1 Bond episode and what it reveals. Now, I want to talk about something very specific because I think it reveals something important about the culture, not just the compliance. HDFC Bank's Dubai branch sold Credit Suisse AT1 bonds to NRI retail customers. These are complex financial instruments. They are designed as bank's capital buffer, not retail investments. When Credit Suisse collapsed in 2023, these bonds were written off to zero. Retail NRI customers lost their money. The Dubai regulator flagged these lapses in September 2025. The bank's response, according to Chakraborty, was to call it a technical lapse, a documentation issue, regulatory interpretation question. Chakraborty pushed back his view. This is a conduct failure, not a paperwork problem. Calling it a technical glitch doesn't add standards of ethics. Now, I'm not here to judge who is right on the legal classification, but I want you to think about what this episode reveals about how the leadership handles uncomfortable situations. Because in a bank where trust is literally the product, how you respond to failure is as important as the failure itself. Eventually, 15 executives were disciplined, 3 senior leaders, including a group head, were asked to leave. But this happened years after original concern was raised. Years. The former chairman pointed out that explicitly the delay in accountability that was part of his problem. And this is where the story moves beyond the numbers, because margins can recover, ratios can improve, but trust, once questioned, takes much longer to rebuild. Where HDFC Bank actually stands. And while HDFC Bank was dealing with all of this, rest of the market didn't stand still. Let me now put HDFC Bank next to its peers. The competitive picture has shifted significantly in last 3 years. The most important comparison is with ICICI Bank. Today, ICICI Bank has a NIM of around 4.2 to 4.3%, HDFC at 3.35%. ICICI Bank CASA ratio is around 40%, HDFC at 34%. ICICI ROE is at 17 to 18%, HDFC at 13.9%. ICICI Bank stock is up roughly around 7% year to date in 2026. HDFC down by 24%. This is not a small gap, and it happened in a relatively short period of time. And for the first time in a long time, HDFC Bank isn't the obvious choice anymore. Now, to be fair, ICICI Bank didn't do a 40 lakh crore merger. They had no integration burden. They have been able to just execute cleanly, while HDFC Bank was absorbed in digestion. So comparing them directly right now has some unfairness built in. But the market doesn't give you the credit for the degree of difficulty. The market rewards outcomes, and on the basis of outcomes, ICICI Bank has won in last 3 years convincingly. Kotak Mahindra Bank is another reference point. Higher CASA ratio than HDFC Bank, lower cost of funds, more conservative growth, but cleaner execution. And more importantly, no governance controversy sitting over it right now. Axis Bank has been gaining market share in retail loans. It's not ahead of HDFC Bank on most metrics, but it's growing faster in certain segment and it's trading at a more compressed valuation. Then there is SBI angle, which often gets ignored in private bank conversations. SBI has been aggressively building its digital infrastructure. It has a CASA ratio of around 42 to 43%, and in a rate cutting environment, PSU banks with a massive deposit franchises can actually compete more effectively with private banks than they used to. What this competition picture means for HDFC Bank. The mortgage market, which is now a massive part of HDFC's bank book after the merger, is intensively competitive. Home loan yields are being pressured by aggressive pricing from ICICI Bank, SBI, LIC Housing Finance. In Q3 earnings call, management acknowledged that aggressive pricing by competitors in mortgages and home loans. This matters because the entire merger thesis was partly built on HDFC's ability to cross-sell financial products to HDFC Limited's existing 5 crore mortgage customers. If the mortgage market is itself being commoditized on price, that cross-sell story is harder to execute than it looked on a whiteboard in 2022. Now, let's zoom out for a second. The interest rate cycle. The interest rate cycle is starting to turn. The RBI has begun cutting rates. For most banks, this is neutral, but for HDFC Bank, it's slightly different, because right now the bank is still carrying a chunk of expensive borrowings from HDFC Limited's merger. As the rates fall, those high cost borrowings start getting replaced with the cheaper ones. So over time, the bank cost of funds comes down, and that directly helps the NIM recover. That's one part of the bull's case. The environment itself is helping the bank fix a problem that would have taken longer otherwise. The deposit war. At the same time, there is a structural challenge across banking. Deposits are getting more expensive. Earlier, customers would leave money in saving account earning 3 to 4%. Today, they are comparing options. Fixed deposits, mutual funds, small finance banks offering higher returns. So the money is slowly moving from low cost saving accounts, which means banks have to either offer higher rates or accept slower deposit growth. And this hits HDFC Bank harder than the most, because it's already trying to rebuild its CASA ratio after the merger. So Just when it needs cheap deposits the most, they are becoming harder to get. So on one side, the rate cycle is helping. On the other, deposit environment is getting tougher. India's credit growth story remains intact. The economy is growing. Retail lending like home loans, personal loans, vehicle loans are picking up. Corporate capex is cautiously reviving. And from the quarter 3 earnings call, the macroeconomic signals are actually quite encouraging. For a bank with 9,600 branches, 100 million customers, and a 29 lakh crore loan book, a good credit environment is actually a strong tailwind. The question is whether HDFC Bank can participate in that growth while simultaneously repairing its balance sheet structure. Where is this bank going? Let me give you the most honest picture I can of where HDFC Bank goes from here. The base case, what management is promising. Management has made three public commitments that I took directly from the quarter 3 earnings call. First is loan growth of 2% above the system in FY27, which means roughly around 14 to 15%. Second is CD ratio reaching 85 to 90% by FY27. Third is NIM recovery in 2 to 3 years as legacy high cost borrowings reprice. If all three happen, you're looking at a bank that has rebuilt its margin, rebalanced its balance sheet, returned to above system growth. The ROE currently at 13.9% could recover to 16 to 17% range. And at that point, the historical 20 to 25x valuation multiple becomes justifiable again. Now let's look at the risk to this base case. The problem with that scenario that it requires a lot of things to go right simultaneously. Deposit growth has to accelerate, the rate environment has to cooperate, the governance situation has to get resolved very cleanly. The new chairman has to align with the CEO. The RBI has to approve the CEO's reappointment without any complications. And the competitors have to stop gaining ground. That's a lot of variables, and if one of them goes wrong, it just extends the timeline for HDFC Bank. Here's the honest truth. There is one question that I cannot find a definitive answer to in any filings or earnings call, and it's most important one. Can HDFC Bank gets its CASA ratio back to 40% plus? At 34% CASA, this is a different business than the one market fell in love with. The cost structure is different, the margin profile is different, the competitive moat is different, the multiple it deserves is different. So here's where we are after three parts. We have understood the business, we have gone through the numbers, we have looked at the management, the competition, and what we have is a genuine case of uncertainty. A bank with an exceptional asset quality and a broken margin story. A management team that is honest but under pressure. A competitive landscape that has shifted. A governance cloud that nobody has fully explained. Now in part 4 is where we will put all of these things together and we will build a risk framework and a valuation framework. And I am in a proper one. And we will arrive at a final stance, not a buy sell recommendation, a framework for how you should think about this stock. Because at this point of time, the answer isn't obvious anymore. So see you in part 4.